everyone. I'm Nikos, Fragos, partner at Karatzas and Partners. Really pleased to be here and join and moderate this panel. The topic is Greek debt capital markets. We promise to keep this focused and exciting. And I think with activities and volumes in this year at record levels, we do have a lot to discuss about. And most importantly, we do have the benefit of a super team of experts, some of them being legends, I would dare to say, on this panel. Won't say names. So let me introduce you to the team. We have Riccardo Abbona, which is head of DCM Italy and Greece. We have Vasilis Tsaitas, Group CFO of HELLENiQ Energy. Vasilis Kotsiras, Corporate Treasurer at National Bank of Greece. And we have Morven Jones, Head of DCM EMEA at Nomura. And last but not least, Dimitrios Tsakonas, Head of PDMA, the Public Debt Management Agency. I think, as historically the case, I will start with the sovereign. So, Dimitri, you were here in the same place last year. And as you know, 1 year after, Friday's scope ratings gave us another uplift within the investment grade club. Our benchmark GGBs yield at par with the French ones. Historical lows also compared to Italy. How far are we from A levels? I would dare to ask you to give some temperature. I know you asked this question yourself last year.
Thank you. Once again for providing me the opportunity of being here 7th year in a row, if I remember correctly. And I need to remind to myself, first of all, what was the missions that were set last year as far as the Hellenic Republic and the PDMA is concerned. Just to remind you, investment grade status is not enough. We need to be back to normality, which means A+. I don't know when this will happen. You need to address the question to the competent authorities, but we do our best in order to accelerate, and we have accelerated the efforts in order to achieve this target. The second target was, in terms, as far as the spreads is concerned, being even tighter, being closer to Portugal, not because we are arrogant and we don't believe that France or Germany deserves being at much better position compared to Greece, but because we believe that we look like Portugal in all aspects, and the last target was the net debt figure being reduced. As far as the last one, this has already been achieved last year. The net debt figure, just to remind you, is the outstanding amount of debt minus the outstanding amount of cash reserves in general terms, plus the arrears, nothing hidden behind the carpet. So this was achieved last year. It is going to be achieved this year. Irrespectively, we have added an additional amount as far as the statistical debt, the so-called statistical debt, due to the incorporation of the deferral of interest payments into our debt. It will be reduced. And as far as the spread is concerned, indeed, we have seen being even inside Italy for a couple of days, France, even just for a couple of days, up to the 10-year maturity. This is based on both fundamental but also technical reasons. I need to testify this. Now, the most challenging part of my job for the upcoming years is how to find space for funding activity, how to find space, let's say, for the next year for 8 billion funding activity. Having in place 48 billion of cash reserves, as the amount stands right now, and as I always say, being a public servant, with all stereotypes, the lazy guy, that incompetent perhaps, and that wants to get paid without doing anything, I could do nothing for the next at least 5 years, and all gross financing needs could be covered due to the outstanding amount of cash reserves. But we need to preserve our continuous presence in the capital markets, to continue having a dialogue with investors community for the simple reason it's a necessity for Greece to preserve a liquid yield curve of the so-called risk-free rates. Why? Because investors want to have this tool, let me in quotes, in order to be in an effort to find having a fundamental approach or fundamental analysis, the fair values of the Greek assets. So we need to preserve this continuous presence. 8 billion, it's too difficult. Let me tell you why 8 billion and not 10 or 6. The gross financing needs for the next year, and I'm referring to interest payments and amortizations, will not exceed the 10.5 to 11 billion. We have stabilized the bill as far as the actual interest payments at less than 5 billion for a long period of time, and this will continue happening. We are going to deliver a primary surplus that, according to the state budget in cash terms, in general government terms, and on a cash basis, will be 5.7 billion. But I'm pretty confident that it will exceed, and I'm referring to the next year, as it happened this year, the 7 billion amount. It remains to be seen. If this is the case, then the remaining space for funding activity is very limited, close to 4 billion. In this effort, the Prime Minister announced recently means a month ago, through Bloomberg, that the potential new early repayment of at least 5 billion of the so-called GLF, Greek Loan Facility Agreement, the bilateral loans coming from 2010, will take place next year, but now, instead of repaying the shorter maturities, now we want to repay what matures from 2033 till 2041. Why we decided to proceed that way? With the upcoming early repayment that will take place this Friday, on 13th of December, we're going to repay, and we're going to be is going to be done as far as the amortizations up to 2028. So for the next government, whichever will be the next government, I need to remind you that we will have in 2027 elections in Greece. We want to provide a window opportunity, a breathing space for at least 2 years without having elevated gross financing needs. Now we have been concentrated to the years 2033 to 2041. The main reason is to convey a strong message to investors community that Greece is going to meet its debt obligations not only for the short to medium term, but also for the long term, and to put a full stop to all these fairy tales of what is going to happen in Greece in 2033. Most probably the Antichrist is not going to come, and most probably everything has been settled down since 2024. Thank you.
Dimitrios, speaking on gross financing needs in terms of debt sustainability assumptions, because this is actually the question, right? On the long run, whether we need further support or not.
Thank you for the question. If you visit our website, we have the so-called investors presentation or funding strategy for the next year. This will be published within the next 15 days. You will find the debt sustainability analysis of the PDMA. According to this analysis, we have taken into account extremely conservative assumptions in all aspects. Just to give you a couple of hints. First of all, the funding cost for the Hellenic Republic for the next 40 years. Just to stress that our time horizon is 2 generations' time, i.e. till 2070, the last year that we are going to repay the outstanding amount of debt. So for the next 45 to 46 years, we have assumed that our cost of funding will be 200 basis points spread versus Bund, and an all-in cost, let's say, of 4.1% for a 10-year weighted average maturity on a weighted average, in weighted average terms. The second assumption that we have taken into account, which is extremely conservative, has to do also with the deferral of interest payments that I mentioned before. We have assumed that this is going to, the amount will be 25 billion, believe me, will not exceed the 23 billion in 2032. 25 billion, and is going to get repaid in 20 installments from 33 to 52, which, if you allow me to say, this clearly depicts what was decided back in May 2018 with the institutions. There is a Eurogroup statement in May 2018 that describes what is going to happen as far as this is concerned. One additional conservative assumption that nobody really knows, or it's not investors are not very familiar with this, is what is going to happen with the so-called contingent liabilities, i.e., the amount of guarantees. As we speak right now, the overall amount of guarantees is 31 billion. close to 20, less than 20, for the time being is 17, but assuming that we're going to grant, the Hellenic Republic is going to grant another 3 billion under the Hercules 3 scheme in order to reduce the NPLs ratio at the levels close to the European average by the end of the first semester 2025, i.e. less than 3%. We have assumed that, and we have also the so-called legacy guarantees, approximately 11 to 12 billion, guarantees that coming from the vast past, as I used to say. We have assumed that 44% of these guarantees will be called within the next 7 years, including this year. I challenge, to be honest, all other sovereign issuers to take this as an assumption too. Last but not least, everybody knows that as far as the NGU funds is concerned, we have an envelope of 18 to 20 billion. It remains to be seen the final amount as far as related to NGU loans, and the rest has to do with the NGU grants. As far as the loans is concerned, we have already disbursed close to 7 billion from the NGU funds for the loans. 5.2 billion have been allocated, have been lent through the banking system to bankable companies. Believe me, we have incorporated this 7 billion in our outstanding amount of debt, but we haven't incorporated anything as far as the asset component, i.e. the loans that we have lent through the banking system to bankable enterprises on a pari passu basis with the banks and with collateral. All these loans have, the companies have pledged the collateral. So just to provide you a confidence that the debt sustainability analysis of Greece, as far as the debt sustainability, we have taken extremely conservative assumptions, and no nasty surprises will be provided by our side in the upcoming years.
Thanks, Dimitri. Moving to the corporate perspective, Vasili, just give us some insights. This year has been a year of robust activity across all sectors, energy, infrastructure, in all types of formats, Eurobonds, mini bonds. What do you see as a direct benefit from a corporate at your level and with your perspective, and how this ties basically with your overall strategy in terms of balance sheet optimization, etc.?
Thank you, Nico. Good morning to all. Many thanks to HELLENiQ for having us for one more year. So I think we should remember that Greece has come a long way since the first time that Greek corporates accessed international capital markets back in 2013. And, since then, a number of large Greek corporates have been able to establish themselves as regular issuers and have DCM as a regular and consistent source of financing. Another important thing that followed soon after was the development of the local capital market in the Athens Stock Exchange, the mini bonds that, Nico, you rightly mentioned, that enable smaller companies that do not have the size to access international capital markets to be able to differentiate their source of funding and finance their growth plans. So, if we look at this journey over the last, say, 10 years, there has been a gradual improvement in terms of the cost, most importantly, which has been a drag and a source of competitive disadvantage for Greek corporates and a higher cost of doing business, the quality of investors and the terms that we were able to come to markets. Furthermore, as Greece now returned to investment grade and the Greek banks also resumed their rating to investment grade, has prompted, it was a step change for Greek corporates. So the spreads have reduced further and effectively removed, to a large extent at least, the significant competitive disadvantage that we were facing versus other European corporates in the previous decade. As the cost of funding of Greek banks reduced, in turn, that went as a pass-through to Greek corporates. So other than the cost of funding in DCM, you have the whole spectrum effectively reducing and rebasing to much lower levels as the Greek banks, the Greek banking system was able to lend at more attractive rates to their clients. And furthermore, international banks that traditionally have been a source of funding for Greek corporates and have left during the crisis, they're back. They're ready to commit balance sheets. So that's an additional cost of an additional source of funding for all Greek companies. Importantly, this is coming at a time that all of us that have gone through the difficult times and have fixed our balance sheets have been able to generate good cash flows over the last few years with the recovery. We're in a much better position to fund our growth both domestically and internationally. So overall, I would say the upgrade of the Greek sovereign and the Greek banks have set a level playing field for Greek corporates to access funding markets, to fund their growth plans. So it feels like we're back to normal. Well, Dimitrios would like to believe that there's much more to go, and I fully agree. But we should not forget where we started from at a time when there was no Greek banking system and capital markets access was very, very expensive. Thank you, Nico.
Thank you, Vasili. Moving basically to banks, Vasili, I've noted here 3.2 billion of senior prefs, 2.4 billion of tier 2. And one tier 1 issuance sounds like a party time, right?
Yes.
24.
It is definitely a party time for the international banks that they are working in Greece. So thank you very, very much for being here. It is a great pleasure as always. It was a landmark year for the Greek financial sector as we have finally met the final MREL target, which was the last of the regulations that we had to follow, and they have been created worldwide as a response to the global financial crisis of 2007. For Greece, because of our idiosyncratic issues, we never could really understand what was the need of it. The real need for it is that the state, going forward, in the case of a crisis, would not have to step in to bail out a financial institution like it has happened back in 2007. So the year was phenomenal. We have issued 7.8 billion, when in 2022 and 2023 we have issued all cumulative around 6.7 billion. So it was a great year. As you mentioned, the mix of offerings from subordinated debt and senior debt with the labeling of the green was really successful, and the demand, it seemed that it has always been there throughout all these transactions. What I can say is that one of the two catalysts that they led us to this acceleration of our issuance plans was first the enhanced profitability of the Greek banks over the last 2-3 years, with the normalization of the rates to a positive territory after a long period of negative rates. That created CET1 that covered part of our MREL needs. And the second one was the IG rating that finally the Greek sector achieved at the beginning of this summer. So it was a great year so far. I think it creates a lot of new challenges that they need. I would say that our projects will be less exciting as we are normalizing, but now we are competing in terms of levels of cost with all the major European banks, at least the second-tier ones. So it's no longer that Greece, one could say a few years ago, that we are cheap and there's a lot of money on the table for the secondary, etc. It is, we have to be at the same arena with the big boys. And for this one, you need to work extremely diligent and very carefully. As the PDMA has shown us, Greece can become a much better jurisdiction than our peers in Europe one of the things that investors are looking very carefully is volatility. And I think that our sector so far is showing extreme resilience to the shocks of the market. And this is something that investors appreciate. So I'm very positive for the years to come.
Thanks, Vasilis. Morven, let's speak about the investor perspective. What have you seen as, as the mix of demand and geography of demand, and how has, the advanced visibility in the Greek market has interacted, with first comers, I would say, because I'm sure there are first comers in the Greek market.
Sure.
And let's talk also about pricing, because I think Eurobank went to the market last week. There seems to be still a premium for Greek banks compared to the same rated EU peers. Still a 3-digit spread over mid-swap, I think.
Okay, thanks very much. Good morning. Always a pleasure to be back at this very high-profile conference for Greece. Just to make a couple of opening remarks, I think we can sense the atmosphere at the conference today. It's been a great year for Greece. No question about that. It's built on solid foundations, and I think there's a lot more to come. But we should also remember that those foundations are the result of a lot of work since the financial crisis. It's not been easy, but the great story, I think, here is that having done that work, the foundation has been built, and you can see the success this year. Specifically, obviously, the shift to investment grade has been a very important sign for everybody, not just the PDMA and the banks, but the corporate issuers as well. What does investment grade mean, specifically from an investor perspective? Of course, for many investors, they manage their funds according to bond indices, and to be eligible for appearance in those bond indices, you generally need to be investment grade. So clearly the ratings upgrade triggered quite a big shift in the demand. I would say that markets generally trade in advance of expectations, and so I think when the PDMA launched its first deal in January after receiving investment grade status, we didn't actually see a dramatic shift in the investor profile, because it had all happened last year, and probably was the case for some of the banks as well. But I do think, certainly from the transactions that we've been involved in, we have seen quite a significant shift in the investor base. For example, a lot of real money investors coming into the order books from the UK, the Nordic region, for example, typically more conservative areas. I would say that the reliance on domestic investors, Greek domestic investors supporting deals has also declined, or been squeezed out, should I say, with the increased international demand. Secondly, I would also observe that the order books themselves for nearly all transactions this year have been multiples of what we've seen before. So I think the most recent Greek bank transaction generated something in the region of 4 billion euro of orders to price a 600, 650 transaction. So these are multiples that you probably didn't see 2 or 3 years ago. And this is real demand. It's not just demand that's been inflated. These are real investors coming into the market. And in turn, of course, as Vasilis was saying earlier, it's given the Greek issuers a lot more leverage to reduce the spread and the pricing at which they've been able to issue debt in the markets.
Thanks, Morven. Riccardo, maybe we can focus a bit on transaction execution and what challenges you see there. And also, you can give us, you're a specialist, covering Italy and Greece. Maybe you can give us also a comparison between the two spaces.
Thank you, Nico, and good morning, everyone. I would perhaps just start by saying well done to both Vasilis and Dimitrios for what they've been doing over the last few years. And I recall a particular situation in which, Vasilis and I tried to organize actually something with investors. It was actually back in April 19. And I was, doing my job positioning Barclays in order to be on one of the NBG trades. And I said to Vasilis, hey, why don't we try to organize a day of investor meetings in Holland? And Vasilis said, well, let's try. So I tried to call up the first 5 investors, and they were, in a way, literally laugh at me, saying, okay, what? An Italian guy calling me up now, offering me a meeting with a Greek bank? What a strange combination, right? And so I had to call back Vasilis and say, hey, sorry, we're not going anywhere, so we're not going to do it. And you know what? I was back in Holland in July this year, and literally people were begging us for a location. So the world has completely changed. But this doesn't come for free, as Morven also said. This doesn't come with just the IG. It comes with an intensive and regular work that has been done by the Greek issuers over the years, going around country by country, unlocking UK first, then the Italians, then the Spanish, then we unlocked Germany and France, and now Dutch and Nordic. So this is an incredible, honestly, journey that I haven't seen so far in my career. Mm-hmm. So well done to them. Going back to your question about the executions, I think there are a couple of developments in the execution when it comes to Greek bonds, especially for FIG, I would say. I think this year, for the first time, we tried to execute a trade in one single day, so with a one-day execution process rather than 2. And this is because clearly, the street, the investment banks, the investors are more comfortable with the risk to sell, basically in just one day without approaching or pre-approaching investors. And this is, exactly in the same direction as the Italian banks and the Spanish bank, the Portuguese banks. This is actually what everyone else is doing, and it's great to have also the Greek banks doing the same. The second point, again, is switching. This is more technical, perhaps, but when we market the trade, we used to market the trade in yield basis up to a few months ago. And this is, marketing something in yield basis usually belongs to, the sub-IG world, more the emerging markets. And for the first time, again, in 2024, we decided to go on spread basis, like mid-swap plus 150 basis points, which is exactly, again, what the Italians, what the Spanish, and all the others have been doing. I think from a relative value perspective, touching perhaps the last part of your question, how are, the Greek credits compared to the Italians, for example. And I think, on the back of all these improvements and announcements in terms of investor engagement, I can say that since, if I look back the last 12 months, and I go back to December 23, and I look the picture right now, well, there has been an outperformance on the spread of Greek banks versus Italian banks of around 100 basis points when it comes to the subordinated trade, and up to 70 basis points when it comes to senior unsecured, which is something spectacular, honestly. And if I look at Spain, well, that kind of gap is even wider, is 150 for subordinated paper and around 100, 120 on senior. So the journey is continuing, and the direction of travel is still extremely, extremely positive.
Sure. Assuming we go deeper into a lower interest rate territory, do you see any impact on the demand? Because I'm sure maybe there is a point on the curve where things may not be that attractive, right?
2024 has been a very interesting year because at the end of the day, the fixed income market was on fire, the credit market was on fire, pretty much all sectors and jurisdictions performed decently well, perhaps excluding France. But for Greece, it was actually an outperforming, and it's still going on. And I was chatting with my trader on Friday before coming here, and I say, hey, do you still see liquidity in the market in these last few weeks of the year when it comes to Greek paper, corporates, and FIG? And the answer was yes, absolutely.
So it's not momentum, it's not physics.
No,
it's
not yet.
It has support.
It has support. There are still inflows coming into the credit funds, and people on the asset manager side has to follow the trend. They have to buy as long as rates are still where they are. Of course, if in 12 months' time we will be, let's say, a 100 or so, or 150 basis point, lower in terms of reference
that's the
rate,
question, exactly.
it's a different
It's
story.
a different context.
But so far, so good.
Okay, so fingers crossed. Vassilis, Tsaitas, in July you priced 450 million euro bond. To get into the same context, give us a view on how strong the demand was.
Sure. Thank you, Nico. So, HELLENiQ Energy is the largest independent Greek issuer with cumulative issuance of over 2.6 billion over the last 10, 11 years. Traditionally, in 2013 we were the first to open the market, and that has happened also again in 2014, 2019, and last summer. And usually other Greek corporates are following suit after us to do their issues. So we set a benchmark in terms of pricing, in terms of structure, documentation, and we always try to do a little bit better than the previous time in order to facilitate the access of other companies as well. So international capital markets have been an important and consistent source of funding for HELLENiQ. Whether sometimes we needed the money or not, we want to be present and retain our footprint in this market. Over the last couple of years, we took advantage of the upgrade of Greece, of the very strong performance of our business, to significantly improve our balance sheet and risk perception and structure. So in terms of our recent issue last July, we priced a 5-year, 450 million transaction with a coupon of 4.25%. We had to upsize versus the original intention because, as I mentioned before, we went out because we had a good opportunity. We tightened the pricing significantly versus IPTs. And important to say that our structure always includes a tender offer in order to facilitate the rollover of an established audience over the years that is following us in every issue. So the rollovers effectively covered around 2/3 of the total. As a result of that, the new issue was oversubscribed by 5 times. Effectively, the last transaction completed a refinancing/repricing cycle that started earlier in the year that included the entire, more or less, banking and DCM portfolio. Following that, we were able to extend the average maturity of our debt to more than 5 years. That's the longest in our history for at least 15 years now. The cost is what would markets call investment grade if you look at the spreads, and we're very happy with that, as I mentioned also before. We were able to rebalance our fixed versus floating exposure while retaining flexibility of our financing. And important to say also that we have excess capacity in excess of extra capacity in excess of 1.2 billion unutilized banking capacity, which is more than adequate in order to implement our strategy. And that comes on top of around $500 million of PF project finance facility that is designated only for our renewables growth. So important also to add that our recent bond transaction comes after a very successful equity placement that our 2 shareholders conducted last year through an accelerated book building process. And I think those 2 capital markets events in the last year, more or less, signify the confidence of the international investor community to the strategy and the prospects of HELLENiQ. Thank you, Nico.
Thank you, Vasili. Vasili Kotsira, let's close with an ESG spin. We worked together on the recent green bond of NBG. Give us some more context and how strong you think is a sustainability-linked product space.
I think that the ESG element of the green seniors that all the Greek banks did after the IG rating was mainly in order to get access to more investors. Greek banks have a large pipeline of renewable energy projects, so it is a natural choice to go green. The important for that transaction, in my view, was more how we would manage to bring Greek banks to the same area of pricing like the rest of the IG banks in Europe. After the summer of this summer, we had Alpha Bank pricing an 81 at 7.5, which was a great success. And back then I was asked, so if we do a senior, we will do it at 350. And my first reaction after the summer holidays was, yes, yes, yes. When I went back at my office, I realized that all the rally that we have achieved through July with the IG rating was fully unwinded for 3 reasons. First, we get the investment grade in July, so the majority of the market participants, such as the international banks, brokers, etc., were still voting on bonds on yield. Then it was August, everybody went on holidays, and at the same period of time, we had the rally on the rates with, after the speech of Mr. Powell, that tightened the whole curve significantly close to 50 to 60 base points. And we realized that we were back at square one when we had issued at the beginning of the year a senior at 180 base points, and Eurobank, with a great transaction in terms of demand, has priced again, after all these events, at 180. We worked very hard to change the positioning of the banks and the Greek banks in terms of the pricing, and the day we priced our green senior at 130 base points, ING was pricing at 115. So I think that was a great success. I would like, just as a final remark, to say that this transaction closed, we managed to meet the MREL final target. It was a strategy that started back in 2016 and it was backed by Mr. Vasilis Kavalos, that unfortunately didn't manage to see this last transaction. For the debt capital markets of Greece, I think it has been a great honor and privilege to whoever of us worked with him and learned from him. Thank you.
Thank you, Vasili. I'll invite any difficult questions, if anyone. Otherwise, I think we can conclude the session, and thank you all for your attendance. Thank you.